Welcome to the LP Financial Services Forex training class, Introduction to Trading Strategy videos. In Lesson 1, Money Management, we'll talk about Part 1, Leverage and Risk Leverage. In the foreign exchange markets, investors use leverage to earn significant profits from the fluctuations in exchange rates between different countries. There are two types of leverage an investor needs to understand. The first is simply called leverage. With leverage, which is provided by the currency dealer to the client, it allows the client to control an amount of currency greater than the amount they place on initial deposit, with only the actual profit or loss of the transaction added to or deducted from their trading account. For example, the client places $100 of account balance on deposit from a $10,000 trading account to buy one 10K euro mini lot. The leverage of 100 to 1 is given to the client from the currency dealer to allow the client to buy the 10K euro lot for an initial deposit of only $100. This leverage equates to $100 multiplied by the 100 to 1 leverage, which is equal to $10,000, which is $10,000, and the value of the mini 10K lot. Most currency dealers provide leverage of 100 to 1, 200 to 1, and even up to 400 to 1. If you choose the 100 to 1 leverage, does that mean that your risk is higher or lower? To trade $100,000 worth of currency with a leverage of 100 to 1, you'll have to deposit and maintain $1,000 in your trading account. The investor with a leverage of 200 to 1 only has to deposit and maintain $500. The Euro USD is calculated using a constant pip value of $10 per standard 100K lot. So if we both put a trade on, investor A and investor B, and they buy Euro at a price of 1.3500, the investor with 100 to 1 leverage to control one standard $100,000 lot would have to put up $1,000 because it's a $100,000 lot times 100 to 1 leverage will let you control that lot. Investor B, with that same $50,000 account, is at 200 to 1 leverage. He only has to put up $500 to control the same contract, because 500 times 200 to 1 is equal to the same $100,000 lot. Now, if the euro versus the US dollar, if they buy it and it rises 100 pips, investor A will gain 100 pips at $10 a pip and make $1,000. If it falls 100 pips, he will lose 100 pips at $10 a pip or lose $1,000. We see investor B with 200 to 1 leverage. He put up $500. If the euro rises 100 pips, he gains 100 pips or $1,000. And if it falls 100 pips, he loses 100 pips and loses $1,000. So from the table, we can see that investor A and investor B are taking the same risk when trading one standard lot. The only difference is the initial funds they invest. If you choose a larger leverage, you could control the same lot with less money. The size of each trade depends entirely on each investor's own investment objective and risk level, and as a general rule, it's not recommended that an investor trade more than 20% of their account equity. So when we take a look at leverage, we see it's the amount of currency that we are allowed to control from the currency dealer, and the amount of initial deposit is required to enter a trade and to maintain that trade. So you can see 100 to 1 leverage at a $100,000 contract would mean $1,000. A $100,000 contract at 200 to 1 leverage would be $500. In our next video, we'll talk about the difference between this type of leverage and risk leverage.